In our previous lesson, we studied about users of accounting information. And we said some of the users of accounting information are investors and shareholders, employees, lenders, competitors, customers, and governments and their agencies. In this lesson, we will study limitations of financial statements. Our objective for this lesson is that by the end of this lesson, you'll be able to state at least 4 limitations of financial statements. Limitations of financial statement are certain information that the financial statement or the accounting information will not report on. We'll look at some of the limitations of financial statement. 1, they ignore vital information which cannot be quantified in monetary terms. We said accounting records only transactions which can be quantified in monetary terms. So no matter how important the information is towards the survival of the entity, if that information cannot be quantified in monetary terms, accounting will ignore that information. For example, transactions or events like death of a director, which is very critical for the survival of the organization, poor health of a manager, poor working conditions of employees, employees' morale, team spirit, relationship that exists among employees, relationship between employees and management. This information is very critical for the survival of the organization. But because this information cannot be quantified in monetary terms, they are not recorded in the books of accounting. Accounting, therefore, does not give us a complete picture of what is happening in the organization. It gives us only a partial picture, only those transactions which can be quantified in monetary terms. 2, financial statements are prepared based on some concepts, assumptions, policies, estimates, and selected accounting methods, some of which are subjective. For example, provision for bad and doubtful debt is subjective. The amount is purely decided based on the opinion of the accountant. So that information, for example, is not objective. 3, fraud and error. Financial statements are susceptible to fraud and errors, which can undermine the overall credibility and reliability of information contained in them. Sometimes management and accountants will connive and prepare statements that will show a very good position of the entity, a very good performance, which is totally different from the reality. They manipulate the financial statement in order to achieve a predetermined result. And this is known as window dressing, where management and accountants prepared false financial statements in order to deceive the general public or to achieve a predetermined goal. 4, different accounting policies and frameworks. Accounting frameworks such as International Financial Reporting Standards, that is IFRS, allows the preparers of financial statements to use accounting policies that most appropriately reflect the circumstances of their entities. The use of diverse sets of accounting policies among different entities impairs the level of comparability between financial statements. In this lesson, we studied about limitations of financial statement. And we said one of the limitations of financial statement is that they ignore vital information which cannot be quantified in monetary terms. For example, the death of a director, the morale of employees, poor working conditions of employees, relationship between employees and management. This information is very critical for the survival of the organization, but because they cannot be quantified in monetary terms, accounting will ignore them. In our next lesson, we will study bookkeeping. See you in the next